There is a 40-minute window 5 days a week when more physical gold changes hands than during almost any other stretch of the trading day. And yet, if you ask the average gold investor in New York, London, or Toronto what happens during it, most of them would have no idea it exists. It is not a secret, it is not hidden, it is simply ignored because it happens while most of the Western world is asleep. That window is the Singapore trading session, and by the time this video is over, you are going to understand why the price action that unfolds during those quiet early morning hours may matter more to your wealth than almost anything you see on financial television. Before we go further, I want to know who is actually watching this, because the answer matters more than you might think. Comment below and tell me where you are watching from, and tell me honestly whether you currently hold gold, silver, or cash. Not because I'm curious for curiosity's sake, but because the distribution of those answers across thousands of viewers in dozens of countries tells its own story about how differently the East and the West are positioning themselves right now. Keep that comment in mind because we are going to come back to what it means later. Let's start with something simple. Markets never sleep, but attention does. When New York closes and London winds down, the baton passes to Asia, and within that Asian trading day, Singapore has become one of the most important hubs for physical gold and silver flow in the world alongside Shanghai and Mumbai. This is not an accident of geography. It is the direct result of decades of deliberate policy choices by governments that understand something the average Western retail investor has largely forgotten. Gold is not just a speculative asset you trade on an app. It is a monetary instrument, a store of sovereign wealth, and in many parts of the world, a cultural and financial cornerstone that predates the currencies most of us use today. To understand why the Singapore session matters, you first have to understand what actually moves the price of gold, and that requires stepping back from headlines and into the mechanics of the global monetary system. Gold's price is not simply a reflection of supply and demand for jewelry or industrial use. It is at its core a reflection of confidence or the lack of it in the paper currencies that compete with it, and the primary lever that determines that confidence is the policy of the world's most powerful central bank, the Federal Reserve. Here is the economic logic stated plainly. When the Federal Reserve raises interest rates, it increases the opportunity cost of holding an asset like gold, which pays no yield. Money flows toward interest-bearing instruments like treasury bonds, because why hold a metal that sits still when you can hold a bond that pays you? This is why gold often struggles during periods of aggressive rate hikes. But when the Fed signals that rate cuts are coming, or when real interest rates, meaning the interest rate minus inflation, start to fall or turn negative, the opportunity cost of holding gold shrinks and sometimes disappears entirely. Suddenly, gold is not competing against a bond with a juicy real return. It is competing against a bond that may not even keep pace with inflation. That is the moment capital begins to rotate. The single relationship, the real interest rate, is arguably the most powerful variable in the entire gold market, more important than inflation headlines, more important than geopolitical scares, more important than most of what gets discussed on financial news. When real yields fall, gold tends to rise. When real yields rise, gold tends to struggle. It is not a perfect relationship, but it is the backbone of nearly every major gold cycle in the last 50 years. Now, layer on top of that the question of debt. The United States, like most developed economies, is carrying a level of government debt relative to its economic output that would have been considered alarming by almost any historical standard just a generation ago. This matters because governments carrying enormous debt loads have a structural incentive to keep interest rates lower than they otherwise would be, because higher rates make the cost of servicing that debt unbearable. This creates a subtle but powerful pressure on central banks, a pressure that does not need to be spoken aloud in a press conference to be understood by markets. When a government owes trillions and its interest payments start rivaling its defense budget or healthcare spending, there is a quiet institutional bias toward accommodation, toward inflation running a little hotter than officially targeted, toward real yields staying suppressed. Gold, historically, has been one of the few assets that responds rationally to this dynamic, because gold cannot be printed, cannot be devalued by a policy vote, and cannot default. This is where bond markets and liquidity enter the picture. When central banks expand their balance sheets, when they purchase bonds to inject liquidity into the financial system, they are, in effect, increasing the total amount of currency relative to the goods, services, and hard assets that currency can buy. This is the fundamental mechanism behind inflation over long periods of time. It does not happen overnight, and it does not happen in a straight line, but it happens, and history offers no example of a fiat currency system that expanded its money supply indefinitely without eventually devaluing against hard assets. Gold has simply been the asset that remembers this longest. It is worth pausing here to talk about why gold and silver function as monetary assets in the first place, because this is where a lot of modern investors get confused. For most of recorded human history, gold was not an investment. It was money itself. Silver, too. These were not abstract stores of value. They were the literal medium of exchange, valued precisely because they could not be created out of thin air by a government printing press or central bank's balance sheet. When the world moved off the gold standard, most dramatically when the United States severed the dollar's convertibility to gold in 1971, currencies became what economists call fiat money, meaning their value rests entirely on faith and legal decree rather than a physical backing. This was a profound shift, and it is one that still echoes through markets today, because it means every modern currency is in a sense a confidence gain sustainable only as long as people believe in the institutions issuing it. Gold did not disappear after 1971. It simply became a kind of insurance policy against the failure of that confidence gain, a way for individuals, institutions, and entire nations to hold wealth outside the reach of any single government's monetary decisions. This is precisely why central banks themselves, not just individual investors, have become some of the largest buyers of gold over the past 15 years. Nations like China, India, Russia, Turkey, and Poland have significantly expanded their gold reserves, and while the specific motivations vary by country, the underlying logic is remarkably consistent. These nations are diversifying away from a reliance on any single reserve currency, and they are doing so using an asset that has functioned as money for over 5,000 years, long before any currently existing governments existed. This is the piece of the puzzle that connects directly back to Singapore. A significant portion of this central bank buying and the enormous physical demand from retail and institutional investors across Asia does not happen during the New York trading session. It happens during Asian market hours when Singapore, Shanghai, and other regional hubs are active and Western markets are either closed or thinly traded. The price discovery that occurs during this window often reflects something different from the speculative derivative-driven trading that dominates Western hours. It reflects physical demand, sovereign accumulation, and a fundamentally different psychological relationship with gold, one rooted in centuries of cultural memory about currency collapse, war, and the preservation of family wealth across generations. Let me tell you about someone who learned this lesson the hard way and someone who learned it in time. Daniel Rees was 34 years old, working in logistics management outside Phoenix when he first became seriously interested in gold in the early 2020s. Daniel was smart, analytical, and diligent about his research. But like most Western retail investors, his entire mental model of the gold market was built around what he saw during the New York trading day. He watched the price tick up and down on his phone during his lunch break, reacted to headlines about Fed meetings, and made trading decisions almost entirely based on short-term price momentum. During hours when he happened to be awake, he would buy when prices were rising, and he felt optimistic, and he would sell in a panic when prices dipped, convinced each time that some new piece of bad news meant the entire thesis for holding gold had broken. Over 3 years, Daniel calculated that his emotional, headline-driven trading during Western hours had cost him nearly 18% in unnecessary losses compared to simply holding his initial position. It wasn't that his underlying thesis about gold was wrong. It was that he was trading against a market whose most important signals were happening while he slept and reacting only to the noisy emotional daytime chop that dominates Western retail sentiment. Greater than. Contrast that with Amaro Kanjo, a 51-year-old physician in Toronto, originally from Lagos, who grew up in a family that had watched the Nigerian naira lose enormous purchasing power over her lifetime. Amber's relationship with gold was fundamentally different from Daniel's, not because she had access to better information, but because her psychological framework was different. She did not see gold as a trading vehicle. She saw it as a multi-generational insurance policy, the same way her grandmother had. When Western markets panicked over smarter about macroeconomics, but because she was calmer, and her calm was rooted in a different relationship with the asset itself. There is real biology behind why Daniel's experience is so common, and it is worth understanding because it will help you recognize the same pattern in yourself. When markets move sharply, especially downward, the human brain activates the amygdala, the region responsible for processing fear, faster than it activates the prefrontal cortex, the region responsible for rational analysis. This means your emotional reaction to a falling gold price often arrives in your body as a genuine physical stress response, cortisol releasing, heart rate increasing, before your rational mind has even had a chance to evaluate whether the move actually matters. This is not a character flaw. It is a survival mechanism inherited from an evolutionary environment where a fast fear response to a sudden threat could save your life. The problem is that this same mechanism, so useful for escaping predators, is catastrophically miscalibrated for navigating financial markets, where the correct response to a short-term price drop is very often to do nothing at all. The opposite emotion, greed, works through a different but related mechanism. Rising prices trigger dopamine release, the neurotransmitter associated with reward and anticipation, and this creates a feedback loop where each new high makes you want to buy more precisely at the moment when statistically prices are often becoming stretched relative to their underlying fundamentals. This is why so many investors buy euphorically near tops and sell in despair near bottoms, doing the exact opposite of what rational, unemotional strategy would suggest. Understanding this is not just an interesting piece of trivia about brain chemistry. It is one of the most practically useful pieces of knowledge you can carry into any market, because recognizing the biological nature of your own fear and greed is the first step toward not being ruled by it. This is also, in part, why the Singapore session behaves so differently from Western trading hours. The buyers moving significant volume during that window are frequently central banks, executing long-term strategic reserve policy, and large Asian institutional and retail buyers operating within cultural and family traditions that treat gold accumulation as a decades-long project rather than a trade. These are not the same market participants driving the emotional, headline reactive swings that dominate the New York and London sessions. The result is a kind of quiet, persistent demand that shows up less in dramatic price spikes, and more in a steady undertone of buying that over time has provided a floor beneath the market even during periods when Western sentiment toward gold has been lukewarm or outright dismissive. Before we go further, I want to ask you to do two small things because the second half of this video ties everything we've discussed so far into a single conclusion that I think you'll find genuinely important. If you're finding this useful, take a moment to like the video, and if you haven't already, subscribe because we're about to connect the dots between Fed policy, currency strength, central bank behavior, and the Singapore session in a way that I think reframes how you'll look at gold going forward. Stay with me until the end because the final insight only makes sense once you've seen the full picture. Let's talk about currency strength and weakness because this is the piece that ties Fed policy directly to what's happening in Asia. The US dollar operates in long, multi-year cycles of strength and weakness driven primarily by relative interest rate differentials, capital flows, and global risk appetite. When the dollar is strong, it tends to pressure gold prices downward in dollar terms simply because gold is priced in dollars globally, and a stronger dollar means it takes fewer of those stronger dollars to buy the same ounce. But here is the subtlety that many investors miss. A strong dollar does not necessarily mean strong confidence in the entire fiat currency system. It can simply mean the dollar is the best-looking house in a rough neighborhood of competing currencies, all of which are being expanded and managed by central banks facing similar debt and demographic pressures. Gold in this context is not just competing against the dollar, it is functioning as a referendum on the entire fiat system, and when priced not just in dollars, but in a broad basket of global currencies, gold's long-term uptrend since the early 2000s becomes even more pronounced, revealing that this is not merely a dollar story, but a much broader story about currency debasement across nearly every major economy. Simultaneously, this is precisely the calculation that many central banks outside the traditional Western alliance system have been making. When a nation holds a large portion of its reserves in another country's currency, it is exposed to that issuing country's monetary policy decisions, and in periods of geopolitical tension, it can even be exposed to that currency being weaponized through sanctions or frozen reserves. We saw this dynamic play out vividly when a range of Russian foreign currency reserves were frozen following the invasion of Ukraine in 2022, an event that sent a very clear signal to central banks around the world that holding reserves in a foreign currency carries a risk that gold sitting in your own vault simply does not carry. Gold cannot be frozen by another country's banking system. It cannot be sanctioned. It has no counterparty risk. This single geopolitical episode is widely believed by economists and market analysts to have accelerated the pace of central bank gold buying in the years that followed, particularly among nations seeking to reduce their strategic dependence on any single reserve currency. History offers us several useful parallels here, and it's worth walking through them not as scare tactics, but as evidence for how monetary systems actually behave under stress. In the 1970s, the United States faced a combination of high inflation, slower economic growth, and a Federal Reserve initially reluctant to raise interest rates aggressively enough to tame it, a period economists now refer to as stagflation. Gold, which had only recently been freed from its fixed price after the collapse of the Bretton Woods system in 1971, rose from around $35 an ounce to several $100 an ounce by the end of the decade, an extraordinary move that reflected a genuine crisis of confidence in the dollar's purchasing power. It took the aggressive, politically painful interest rate hikes engineered by Fed Chairman Paul Volcker in the early 1980s, raising rates into the high teens, to finally break the back of that inflation at the cost of a severe recession. This episode remains the clearest historical example of what it actually takes to restore confidence in a currency once inflation expectations become deeply embedded in the public psyche, and it is a lesson current policymakers have studied closely, precisely because none of them want to repeat it. Then consider the Asian financial crisis of 1997, which began with currency speculation against the Thai baht and rapidly spread across the region, devastating economies that had until that point been considered emerging market success stories. Countries with insufficient foreign currency reserves found themselves unable to defend their currencies, leading to painful devaluations, capital flight, and years of economic hardship. This crisis left a lasting psychological imprint across Asia, one that directly informs the modern approach many Asian central banks and households take toward reserve diversification and gold accumulation today. When you understand that a significant portion of the demand flowing through the Singapore session is coming from a part of the world with living institutional memory of 1997, the persistence of that demand becomes much easier to understand. And of course, there is the 2008 global financial crisis, a more recent and perhaps more universally remembered episode in which the collapse of the American housing market and the resulting banking crisis forced central banks worldwide into an unprecedented era of monetary easing, near-zero interest rates, and quantitative easing programs that expanded central bank balance sheets to levels that would have seemed unthinkable. In prior decades, gold rose substantially in the years following 2008, not because of any single dramatic headline, but because investors, and increasingly, central banks began to internalize just how extraordinary the monetary response to that crisis had been, and how difficult it would be to ever fully unwind it. Each of these historical episodes shares a common thread. They represent moments when confidence in the existing monetary and financial architecture was tested, sometimes gradually, and sometimes suddenly, and in each case gold served as a kind of pressure valve, a place where capital could flow when trust in paper promises weakened. This is not speculation about the future. It is simply an honest reading of the past. Let me share one more story because it illustrates the practical implication of everything we've discussed. Margaret Shen was 62 years old, approaching retirement, and had spent much of her working life as a small business owner in Vancouver. She had a modest but meaningful allocation to gold, roughly 8% of her overall portfolio, which she had built slowly over nearly 2 decades. Margaret was not a trader. She rarely checked prices more than once a month, and she had no interest in timing the Singapore session or any other specific trading window. What she understood almost intuitively was the difference between speculation and preservation. Her gold allocation was never meant to be her highest returning asset. It was meant to be the ballast in her portfolio, the piece that would hold its value or even appreciate during the exact periods when her stocks, bonds might be under the most pressure, periods of high inflation, currency weakness, or systemic financial stress. When market volatility spiked during periods of economic uncertainty over the following years, Margaret's portfolio experienced meaningfully smaller drawdowns than those of friends who held no hard asset diversification at all, not because gold went up dramatically every single time, but because it behaved differently than her other assets when it mattered most, providing exactly the kind of diversification benefit that decades of academic research on portfolio construction would predict. Now, let's bring all of these threads together because this is the insight that everything in this video has been building toward, and I promised you it would connect. The reason the Singapore session matters, and the reason so few Western investors pay it any attention, is that it represents a fundamentally different set of market participants operating on a fundamentally different time horizon and psychological framework than the traders who dominate Western headlines. While much of the Western financial media narrative around gold focuses on short-term catalysts, Fed meeting outcomes, employment reports, momentary risk-on or risk-off sentiment, the deeper, more persistent driver of gold's long-term trajectory has increasingly been the slow, steady, strategic accumulation happening in Asia and among central banks globally, much of which is transacted, priced, and settled during hours when Western markets are asleep. This is not a conspiracy. It is not a secret cabal manipulating prices behind closed doors. It is simply the natural consequence of where the world's largest pools of long-term known speculative gold demand happen to be located, and the fact that those pools operate on a different clock than the one most Western retail investors are watching. The conclusion this evidence points toward is not that Western investors should panic or make dramatic changes based on fear. It is something quieter and I think more useful. It is that understanding the structural long-term forces shaping gold's price, real interest rates, sovereign debt dynamics, central bank reserve diversification, currency competition, and yes, the quiet accumulation happening during the Singapore session gives you a far more stable foundation for decision-making than reacting to the emotional noise of any single trading day. The investors who have done best with gold over the past decades have almost never been the ones trying to trade its every fluctuation. They have been the ones who understood why they owned it in the first place, and who let that understanding anchor them through the inevitable periods of volatility and uncertainty. If there is one practical takeaway from everything we've covered today, it is this: gold's role in a well-constructed portfolio is not to make you rich quickly. Its role is to preserve purchasing power across long stretches of time, particularly during the periods when confidence in currencies and financial systems is being tested, whether by inflation, by debt burdens, by geopolitical rupture, or simply by the slow, patient recalibration of how the world's central banks choose to hold their reserves. Understanding the Singapore session and the broader Asian demand dynamics it represents will not tell you what gold's price will do tomorrow or next week, but it will help you understand why gold has behaved the way it has over the long arc of recent economic history, and that understanding, more than any short-term trading signal, is what allows an investor to hold their position with confidence rather than anxiety. We are living through a genuinely unusual period in monetary history, one where debt levels, currency dynamics, and geopolitical tension are all converging in ways that deserve careful, sober attention rather than either blind fear or reckless speculation. Nobody, including any economist, any central banker, or any analyst, can tell you with certainty what the next several years will bring. What history can tell you with a fair degree of confidence is that periods like this have occurred before, that human institutions have navigated through them before, and that individuals who approach those periods with patience, discipline, and a clear understanding of what they owned and why tended to come through them in far better shape than those who let fear or euphoria dictate their decisions. So, as you go forward from here, whether you choose to hold gold, silver, cash, or some combination that reflects your own circumstances and goals, I would encourage you to do so with your eyes open, informed by evidence rather than headlines, and grounded in an understanding of the deeper forces at work beneath the daily noise. Stay curious. Stay skeptical of anyone, including me, who claims to know exactly what happens next. Avoid the trap of emotional investing, whether that emotion is fear or greed, because both are ancient biological responses, poorly suited to modern financial decision-making. And above all, focus on preservation and patience over prediction and panic, because in the long run that is what has always separated those who build lasting wealth from those who simply ride the waves of momentary sentiment. The world is complicated, The future is uncertain.